All right. Good morning. It is August 18th, 2025. Welcome to Coffee Talk. Not a lot happened this week. I do have a lot to talk about because, when there's not like a lot of news, I'm just gonna go find old stuff and we're gonna talk about people and things and companies and kind of all of those good things. Just to feel the time and the space because I'm up early and it's football week. I do have like football season, high school football season starts this week. So, yep, my last high school football season. So feeling pretty energized for the week, which could be good news or bad news for some people. But anyway, let's just jump right into what we're going to talk about today. We're going to talk about an interview with Mr. Bad Faith himself that happened, I think, a couple of weeks ago when this interview actually happened. And I was just now getting around last week into listening to it, and I'm going to share that with you. CCC reaffirms a press release. I don't know what it's going to take for you people out there to finally like stop listening to CCC, but we'll talk about them again. Allstate makes an email mistake. That's nothing new. We're going to talk about Greenfield versus Brownfield and MSO growth, kind of like just play off a little bit more conversation about what we talked about last week. And because of that, I actually got a bunch of questions. People wrote in and said, hey, Kristen, what's Fox Collision and M2? And then I thought about it for a while and realized um, I've become one of the old people in the industry. Like I don't feel that way. I definitely don't see myself that way, but I did the math and the people that were basically writing in, a lot of them were like 2 years old when that when that happened. And so of course they don't know about it. So we're gonna have a history lesson today. We're gonna talk about Fox Collision and M2 Collision and what that was and what happened and how it changed some things that some of you people may not even, some of the old hats may not be aware of the changes that brought about. We're going to talk about the breakup with blending. I've been talking about this for, I went back and it's been about 2 years now. I've been talking about be prepared what the insurers are about to start doing with blending. And everyone laughs and scoffs and says, no, 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 that'll never happen. And that's probably why I'm just about out of Jack Daniels. So if you watched 2 weeks ago and you heard the story about that bottle of Jack Daniels Sinatra that sits on my shelf, we're going to talk a little bit about that and share some of the things that people have been running into. We're going to talk about because I got some comments online that just cracked me up. For the record, people, I just want you to know it's 4:36 in the morning, right? Like, I don't do this show weeks in advance. This isn't a fancy podcast for me. I come to my office at 4 to 5 in the morning on a Monday morning. I turn on the Zoom and hit record, and it is one continuous session, no editing. There's no music added, there's no stingers, there's no nothing. It's just me at 4 o'clock in the morning sitting in my office with some sort of caffeine. Yeah, yeah, we're gonna share people's thoughts on some things and some posts that were made online just because it's fun. Why not? But was it Jimmy Kimmel does mean tweets, or was it Kimmel, or is it somebody else that did mean tweets or whatever? So we're gonna talk about that. We're gonna do speculation on the MSO futures. So after some of the crash news, the trade press actually ran the articles and made the references back to Service King in 2000. And so we'll do some speculation and talk about that. And then we're going to talk about this insurance ecosystem report that came out. I do think it's really, really important that people in the collision repair industry, specifically collision repairers, get your news from other places than collision trade or from your jobber or from some trade show you go to. So make sure that you're not allowing a very curated form of information to sway you. So very much like we talked about this whole iCar debacle, and everybody's like, there's no independent repair representation on iCar. Sure, there is. That shop just happened to have sold, and so we can leave him, we can ask him to leave, we can do whatever, but there needs to be a much more broader um, source, or you need to look for more information for your news. And folks, that would really go for anything in life, your political news, your whatever. Stop looking to Facebook for news, and actually like think about the news you're hearing and what perspective it is. And that even goes from what I tell you. Think about the perspectives or what my goals or whatever might be. Okay, let's talk about Mr. Bad Faith. Jay Feinman there is the author of the book that I cannot stand called Delay, Deny, Defend. Now, when this book kind of came out, I was a very young adjuster and I took it personally because I can personally attest. I've handled large loss property. I've handled large bodily injury with attorneys. I've handled all kinds of files in my years, and I never at one time had been told that there's this strategy to keep from paying claims. So I took it personally. It kind of really offended me what he said in the book. So let's just take this for, I want to put a disclaimer on this. I'm not a fan of Mr. Feinman. However, he is a very well-known and respected legal scholar, specifically around insurance claims and claim law. So he testifies, he goes to Washington a lot of people go after, seek his opinion and insights. He's a professor at Rutgers. You Jersey people over there, I always used to joke, because I'm mean and that's what I do really, really well. I used to joke with people and say, look, man, if this guy was half as good as he says he is, there's probably not a state that's any more screwed up than New Jersey is when it comes to claims. So if this is where he resides and he's at the university there, maybe we probably shouldn't pay attention to him. But again, I took his words very, very personal in the early years of my career, and I still do. I still was never trained to do any of these things. But there's a lot of people in the collision industry that like to sort of quote this book, and they like to throw it up. And every time there's a discussion or something happens on Facebook or a story on LinkedIn or whatever, you'll see some people come in and go, oh, you should read the book, Delay, Deny, Defend. And probably under their comment, you probably saw me going, that book sucks, right? But this interview, so the Merlin Law Group is a law firm out of Texas that does a lot of insurance litigation, particularly homeowners. That's really their specialty. There's some really interesting lawyers and law firms in Texas, including a law professor that's at SMU that I really hope one day I get to meet and spend some time with. But Chip Merlin here of the Merlin Law Group did an interview with Mr. Feinman, and it is available on YouTube. So you can see there, that's the title of the video. It's called The Claim Game with Chip Merlin featuring Jay Feinman. So for those of you that are only listening to the podcast audio version, he spells his name Feinman as the author of Delay, Deny, Defend. Now this is I want to say it's a 1 hour, just a little bit over an hour interview. There's a lot in there that I think might not be, if you're not, if you're not engrossed into the claims world, it would lose you. But I would tell you at about the 18-minute mark, that's really where you would want to fast forward and start listening here, because there's a discussion on bad faith claims. And you'll hear us talk, or you'll see people talk often online about that's bad faith, or what is bad faith, or you have an Unfair Claims Practices Act, and the whole purpose of it is to prevent bad faith. So they do a pretty good job of explaining this National Association of Insurance Commissioners, sort of what I'm going to say, we'll know later while I think, because again, this is not edited. This is 4 o'clock in the morning coming off of my brain. I've had 2 cups of coffee. I've moved on to a more cold version of a drink, but I've had 2 cups of coffee, so I'm feeling pretty good this morning. But there's a discussion on how that there was sort of a template law. So the nationals kind of write this template, and then each state kind of had its own little things. And then there's been case law and cases across the years that have changed the way unfair claims practices, bad faith cases, some things are interpreted. And in some states, it's very, very hard to make a bad faith case. The insurer, and they're not wrong, the insurer is entitled to make a mistake. You're entitled to miss a piece of evidence, or to interpret something wrong, or an adjuster just they're not that bright, right? You're entitled to make a mistake and it not necessarily be bad faith. In those cases, that's usually a big hurdle to get over to keep a bad faith case when those have that. So he talks about kind of how hard it is to get bad faith and then why that's a bad thing. So a lot of it, people, you'll see there's some legislation right now going around nuclear verdicts and trying to reduce what plaintiffs can get, what's realistic compensation for what happened. And nuclear verdicts are a problem. But I don't disagree with OJ here, and I hate it because, I've spent 30 years of my life talking trash on him because I didn't like his book. But I'm not necessarily disagreeing with him in the point that litigation is an important form of regulation. So there is regulation within states and the way that they regulate insurers. But litigation has always been sort of that big stick to make you want to behave. And as we've gone through the last 15 to 20 years, that litigation around auto claims just feels non-existent. We all got super excited over the Shebashan case, but that was tort law. That really wasn't a bad faith case. State Farm was filed against, but got it. They sort of went all John Wick and got themselves taken out of that, and old Todd disappeared for a little bit. But there's not been a lot of that litigation. And when there is no litigation and there's nothing to fear, in other words, there's not a boogeyman sitting in the woods that's going to hit you for, I believe, what was it? The Avery case was like a $1 trillion verdict. Let me tell you, when that one came down, that was a bad day in the claims office. Most of us were sitting in the office going, I don't even know what a trillion is. Like, what is that? How did we lose $1 trillion in a lawsuit? Like, what do we even do with that? But that fear of that boogeyman in the woods, that huge, enormous amount of a bad faith verdict sort of kept you in line. I always tell I tell my kid, my dad was really cool. He's really funny. But when he would get mean, there was no doubt who was in control of the family. And so I was not a great child. My brother was a saint. If any of you know my brother, then you would attest. My brother is a saint. He never did anything wrong. I decided to make up for everything he didn't do as a child. But you knew there was a line, right? And you didn't go over it because the fear of dad getting mad, that was all I needed. I didn't need him to actually follow through with it. Good God, that would have been a nightmare, but just the fear of it. So that's very similar litigation and child raising. I don't know how that works, but there has to be this thing. I need to be afraid of that. I need to value people over premium. I need to value service over KPIs. There's all these things that I need to do. And he has a great discussion where he sort of talks and explains with what's happened with bad faith, and sort of the rules, like what you have to do to get to a bad faith verdict, and then what he believes that's kind of done to claims. Again, their focus is really more on medical and homeowners because those are large losses, but there's a lot there for us to think about in the auto world. Now, one of the things that he mentions in his little interview here is he talks about, this is a public document, so all of you can go and download it. It's the National Association of Insurance Commissioners, and it's a market regulation handbook. Well, that's what insurance commissioners do. They regulate the market of insurance within their state. 90% of their time is on health insurance, right? That's the biggie that everybody sort of has to deal with. And then probably the rest of that, there's workers' comp, there's homeowners, and there's a tiny, tiny bit of auto in there, but auto's picking up. This is really good information. And shops should get this. This is a huge document, by the way. It's like 1,000 and something pages. It's definitely not entertainment reading. It's very much educational reading. But what it does is it lays out how an insurer conducts a market survey or a market regulation investigation, what you do with it, the questions you ask, everything. And what really comes down to it, if we go back to insurers are allowed to make a mistake, right? then for you, not really you, but for a customer or a group of customers, if it's going to be a class action, to get a bad faith suit filed and it stick and not be kicked out um, for no cause or for whatever, is there has to be some evidence there that this was a deliberate thing. This wasn't a one-off. This wasn't one adjuster that made a mistake on one file, that this was a business practice, that this was intentional, that this was deliberate. And the way that we help with that as shops is with how we document the emails we write, the emails we get back, the way that customers file Department of Insurance complaints. I hear shops all the time go, there's no point in filing it. It's not going to make a difference. You're probably right. On that one claim that you're associated with at this moment, probably not going to make a difference. It's not gonna, you're not gonna magically get paid. Sometimes you can write a brilliant complaint and magically get paid. You go, whoop, I struck a nerve somebody was aware of. They didn't want it to go any further. But it's just a matter of getting it on record. And when you have a record of the same issue, that's all I always tell shops and consumers. Insurance department complaints cannot be, they're not paying me enough. I didn't get enough of this. There has to be a pattern, and you have to keep sort of complaining about the same things over and over, and then being able to show that they were owed. So if you just complain, that kind of means nothing. Texas did a really good job of following up on their RTAs. So you'd have, here's the RTA, here's how much the insurance company wasn't paying, here's how much the RTA decided was owed, so here's how much the insurance company was wrong. Had the consumer not pushed it, had they not filed the RTA, had they not gone to small claims court or whatever it was, here's what they would have lost. That's a very, very important part of sort of putting a bookend on a complaint. In an RTA, you may have a two-part complaint. There's the original complaint. Hey, this stinks. I'm having to like pay extra money out of my pocket to go to RTA to try to get paid, what I believe I'm owed. And then you come back and go, hey, looks like I was right. Here's how much more I got because I executed the benefit under my policy of RTA. Well, if I can start showing that, we'll just pick on Progressive because we're going to pick on Allstate later. So we'll pick on Progressive right now. But let's say I have 15 RTAs with Progressive, and in all 15 of them, they've denied paying paint and material difference. And in all 15 RTAs, paint and material differences has been one of the things that gets paid. Well, then now it's intent. You've been told more than twice that you're wrong and you should consider that, but you still refuse to, which means more customers are having to spend money for something you should have learned. Like, this is now market conduct. But it becomes really important that shops do it. I think if you read the market regulation handbook and understand not only just what a DOI can and cannot do, but more of how they go about doing it, what that looks like, the questions. I mean, there's everything in here from investigation techniques. And again, the National Association of Insurance Commissioners puts out a guide, a suggestion, so to speak, and each state has to decide what to adopt and how to do it and what they want to have. But it's very, very good. So I would go watch this interview from the Merlin Law Group on YouTube. He has a really, the Merlin Law Group has a LinkedIn page. So if you're on LinkedIn, you can go follow him. He does interviews every couple of weeks with people very much around litigation of insurers. So if that's something that interests you, and you want to kind of like keep an eye on that and see what's out there, just like there's people that their job is to litigate against OEs. I follow those people as well. But really interesting. And like I said, I'm not a Feynman fan. That book hurt my feelers when it came out. I want to say 20 something. It's probably longer than that. It's probably 30 something years since that book came out. Hurt my feelers when it did come out. But he does a really good job in this interview of kind of explaining truthfully the role litigation plays in regulation. Like, I don't think any of us believe a $1 trillion verdict is reasonable. Nuclear verdicts are bad for everybody, but litigation is very, very important. You need to be afraid of something. I'm not afraid of an $8,000 property damage lawsuit because you don't think that we paid enough to fix your car. I'm not afraid of that. But if I don't handle that right, there's a bigger gremlin out there. Woo, see, automatic camera. See, I don't even edit this. There's a bigger gremlin than I need to be afraid of. Look, I'm gonna zoom it back out and let you guys watch how that happens. um, I'm gonna really try to annoy some people with but I don't know if I can do it now that I'm being conscious of my We'll see how that goes. But really good interview. I definitely recommend, and I've got some other recommendations for things that I think you are too. Oh, there it is. Study and follow up on. All right, let's talk about the blend breakup. It's coming, folks. The insurers are pushing that KPI of average refinish. The adjusters have been told not to pay for blend. Now we showed you. No, I didn't show you. I'll show that to my private class. My private class got to see the rule set. So what insurers, the rules are for estimate, so artificial intelligence estimate reviews, and they saw all the ones where it kicks out for blend. Like if a shop puts blend on an estimate, it's pretty much getting kicked out for review, basically. But insurers are very much into the reduction of refinish time. There's a lot of reasons, right? More than just the labor time on it. There's also that material cost with it. And so that's almost, refinish has been one of those things traditionally you could try to control with a KPI, and it was really good at controlling your severity because it affected two labor columns. So that was wonderful, right? But there is a growing assault. Now we can argue back and forth. So this particular posting is a gentleman at a shop down in Florida having some problems with Geico, where Geico's refusing to pay any blending. And it's not like they're saying, I've had some people go, well, they tell us no, but then once we get it in the paint booth and can show them the pictures, they say they'll pay it on the tail end. I think that's awesome. Probably, I want to believe that that's a lot of what maybe the insurers are instructing, and it's getting lost in translation. So they're saying we don't pay for blends unless you can show us in paint or whatever. And all the adjuster hears is we don't pay for blends anymore. That's part of that education. Careful what you see. There's the okay. Careful what you tell them is a rule or a KPI, because if they don't have the knowledge to apply critical thinking to it to make a decision, then the default is always no. The default's not a yes. Anytime I don't have enough information to make what I feel is the correct decision, the human brain's going to say, just say no, right? You can't necessarily hurt yourself by saying no, but you sure could hurt yourself by saying yes. This assault on blending will continue into next year as we get closer to the fourth quarter of 2026. You're going to see more blending, denials. So not more blending being paid. You're going to see more blending denials, more time and energy around it. It's going to get rough. It just is. It's going to get even rougher. I started talking about this a couple of years ago because technically, if we want to just go for purity of the policy, an auto damage policy is sudden, direct, accidental, physical damage. That's what an auto policy pays for. Blending doesn't fall in that category. Most people go, but that doesn't match, and you have to restore the vehicle to pre-loss condition. No, I don't. And in most policies, you don't. That language isn't even there. It's just sudden, direct, accidental, physical damage. For the last 15, 20 years, the insurers have been pushing this on the homeowner side and restricting what they pay for matching purposes over there, whether it's matching slopes of shingles, matching siding, matching paint, continuous wood flooring, or continuous carpet. Like they've just been pushing that button to, in a way, see how far it'll go before there's a case or a lawsuit or whatever. And you're going to start seeing that trickle over, just like some of the paint companies. They've gotten rid of, I don't want to say gotten rid of, but they've gotten rid of automotive refinish people. And now we have people from architectural coatings, homeowners who paint houses, involved into the automotive refinish side. Somewhat, a little bit of, there's occasionally some crossover, but there's definitely some sit down meetings. Someone who's a VP of claims who may oversee both homeowners and auto in some sides looks at that and goes, well, why can't we do that to auto? You're starting to see that. You're starting to see more insurers push back on blending. And that's, I believe it's going to get worse. So when I was saying it 2 years ago, everyone was like, she's just making it up for clicks and likes and and trying to scare people into buying training or whatever. No, but here we go. So as you see more people posting these things online, it's almost every day I can go in one of the groups and I can find somebody posting a blend or a refinish issue. We made a post about it and had a lot of mixed bags. We had people say, yep, I'm seeing all these denials. I'm really having to fight for blending. I'm really having to get the customer involved. And then we had a lot of people go, okay, yep, they're denying it up front, but as soon as I send them the pictures and everything, they get us paid. There was a big push in the Houston market right now to not pay blending. Several of the shops have wrote back and said, yeah, we had to send in a bunch of evidence, but once we did, it was taken care of. But something to keep an eye on. Okay, CCC, good Lord, people. I think the confusion with CCC is too many of you believe that they care about the health of body shops and whatever. And I've been around this long enough, and it's not just them. The estimating systems in general care about the insurers. Bottom line. And you've taught them that. Everybody gets mad at me for it. And I go, but you taught them that, right? You didn't keep an estimating system because you wanted it. You guys got on DRPs, and then when the DRP told you had to have one, well, you got it, and you didn't question it. And most of you have 3 damn systems, probably not anymore because Autotext, I don't believe they have anybody left. But most of you are carrying 2 estimating systems and 2 subscriptions and paying an astronomical fee for something that's software online. Some of you are paying like $900 per person per month for a software license, but you're paying these astronomical fees for software because an insurer, one, is either making you do it, or I hear something like, well, I want to be apples to apples when I'm negotiating with an insurance company. So it's not unrealistic, or I don't necessarily blame them for caring more about what an insurance company thinks, does, or needs than collision repair shops. Over the last year, we've seen more concerning things when it comes to software. Labor times are decreasing, refinishing times are decreasing. There's been no labor studies. There's never a discussion around it. And a lot of shops have been recording a lot of conversations. And in these conversations, insurance companies are saying things like, we set the labor rate based on what CCC tells us. That's not new. See a little insert, and I'll share this here. This also came out in 2020. John Huter, Repair Driven News, covered it then, because while CCC was saying we don't report and we don't share that information, then they also on their website under the insurance section said, hey, we have this thing called the benchmarking report. Now, I'm going to put my insurance hat and I'm going to go back in my time. I would have a market. That market may be 3 states. So I may have Tennessee, Mississippi, and Louisiana. I may have those 3 states as my responsibility. And CCC would give me reporting on what the market in those 3 states looked like. And that market would include things like labor rates, average refinish, repairability, alternative part usage percentages, whatever. And I would benchmark my adjusters to the market, and I would benchmark my DRP program to the market. That's the benchmark. And I would either see we're performing well in this or we're performing low in this. Get on the national scale, you get that report, little national, and then you can drill it in almost even to a city within a particular market. So just let's say Texas, for instance. Looking at the market in Texas, that's a big state, right? Or California, there's a huge difference between San Francisco and San Diego. I need to be a little bit more narrow in my focus if I'm going to look at market reports in those 2 states, right? I can't just go, well, this is what the average is in the state of California. That wouldn't make any sense, really, right? So I got to get a little bit more dialed in to be able to get this correct. See, we're live. I got some alarm going off and I don't even know what it is. We didn't hear that beeping. All right. So CCC again gets told, hey, we have repairers. They've got these recordings. These insurance adjusters and insurance managers have said these things. Do you do these? And CCC writes back and says, no, we don't. All right, I'm going to agree. CCC does not do a labor rate survey. Neither does State Farm. I don't know how many times we have to tell people that, but by all means, keep plugging in rates to the B2B site, thinking that you're making a difference. That's wonderful. But they don't. They don't do a labor rate study. Do they do benchmarking reports? Absolutely. And I don't even have to share what I know here because we can just Google and look at things that have come out in the past. So in 2024, last year, CCC puts out a report and lets us know that there is a 4.7% rise in rates. Collision repair labor rates have continued to increase, with CCC data showing a 4.7% rise. Wait, I thought you weren't tracking labor rates. I thought that wasn't available information. Here we go. This is Repair Driven News published a story. This increase outpaced inflation and contributed to a 3.7% rise in total repair costs. Now, I want you to hang on to that number because there's another really, really important document that we're gonna look at here later. The average number of labor hours per claim, not per repair, right? Per claim, saw a slight increase reaching 27.4 in the first half of 2024, down slightly from 27.6 in 2023. Sounds to me like you're tracking labor rates, you're tracking labor times. I don't blame you. You're a data company. Your user agreement says basically we agree to use the software and you get to keep the data and do with it as you please, so to speak. Then this was my favorite. So in 2024, this came out for insurance companies. It was a really wonderful little graphic. What do they call those? There's a name for them. Infographics. It got handed out. It was in insurance publications. I'm sure it was probably at the insurance company trade shows. This is my favorite. So for 2023, so remember before we said that in 2024, labor was up. In fact, let's go back. Let's make sure that we are accurate in what we say. So for 2024, it was a 3.7% rise in total repair costs. So in other words, CCC says in 2024 that labor rate raised repair costs by 3.7%. All right. In 2024, they said that they put this little infographic out, and I want you to see we've blown that one area up for you so you can see it better. Because for 2023, they said that labor rates added 7.4% to the overall repair cost. All right, folks, you want to know why insurers are so hard on labor rates for you and why they push this and they deny it and they fight it as bad as they do? It's because they're given information that tells them that the reason that repair costs are up is because you're raising your rates. Not because we probably should be writing estimates more correctly. We should be including more procedures. Parts got more expensive, inflation, paint, everything. It's you bad shops there raising your labor rates. But that's their graphic. They share it, they print it, they give it to the insurers, they pass it out, it goes into the publications. In fact, the title of this one is The Impact of Vehicle Complexity on Auto Claims and Repair. So why does everybody feel like the insurers get their repair labor information from the estimating companies? Because they do. Whether it's directly in a report, a benchmarking report, whether it's running reports based on the estimates that are sent either through your DRP program or subrogation, that's where it comes from. It's not a labor rate survey. It's not some survey freaking genie. It's none of those things. It's what is uploaded. In other words, you've put it in an estimate, you've sent it up in the cloud, meaning you've handed this to somebody. This is what you say your labor rates are. Body shops, if you want to change labor rates in your market, change the labor rates you upload. In other words, that last sheet where you enter your rates, like there's a reason when an insurance company makes a concession, they don't change the rates. They make a line entry that says concession for repair, $3,483, because all reports are driven off of what is entered into the labor rates. If it didn't matter and CCC wasn't reporting on it and it wasn't driving what was being paid in the market, then why wouldn't the insurer just change the rate? But they don't, do they? They make a line entry that says concession or agreement to settle or whatever that is. If you want to make a change, then you have to change what is in those labor rates. Now, if you want to give a concession, so in other words, let's say your market is currently paying 56 and you want to go to 60. You need to change your rates to 60. If you want to go in and make a one-line adjustment that says market concession given for, whatever, that's fine. Now DRPs, you're stuck. You're going to put it at whatever labor rate they tell you to do. But independent repairers, that's one of the things that you can have control over. You don't necessarily have to make the customer pay if you don't want to. I think it's great when you make the customer pay. But if you're not there yet, at least think about, what am I saying legally? So I tell every shop, you can have a sign on your door that says our labor rate's $80, and it don't mean a damn thing. It's the same as a hotel. Next time you guys check into a hotel, I want you to go look at the back of the door on the hotel, and there'll be posted rates. If you're in Vegas, it's like, this hotel is $2,000 a night. And you're like, who the hell would pay $2,000 a night for Circus? Nobody. But if they don't have it posted, they can't charge for it. So they have that in there. Maybe, I don't know, maybe Taylor Swift's going to be in residency. We're going to talk about Taylor Swift later too. It's going to go to residency in Vegas. And suddenly people would pay $2,000 a night for a hotel. I have no doubt for that. But if it's not there, they can't do it. So it's the same thing. There's a difference between what you say you're going to charge for and what you actually charge for. What you upload is what you say you're going to do. If you did that, if you actually controlled that, control the controllables, what you can do, then it wouldn't matter what CCC is or isn't sharing. I don't have a problem with them sharing that data. It's what you said you're charging. It's not like they're making it up or altering it in any way. It's just your data, like, served back up. So, like, I always tell people, I love to pick on them. I really do. Like, there's a couple of companies, like, I love to pick on Aztec. I love to pick on CCC. I love to pick on Tesla. But they're not doing anything wrong. I don't know why shops would even, if you don't like it, change it. I mean, that's kind of the way it is. But anyway, let's talk about Allstate. Speaking of things shops are complaining of from insurance companies. So this one came out. Allstate sent an email out to a bunch of shops, and it basically said that Allstate had reached an agreement on what they were going to charge for calibrations. And some of this had been blacked out. It included Aztec and Opus. Those are the two names that everybody likes to throw around. I kind of get a chuckle out of this because, like I said, I love to pick on Aztec. But when things expanded, particularly with State Farm, there was like 4 names of 4 different companies listed, but everyone's just kind of stuck on the Opus thing because it was Opus Map. That kind of happened. But Allstate comes back and says, no, we have no pricing agreement. These are approved vendors, preferred, but not the only ones that shops can deal with, and we don't have a pricing set or whatever. The reason they got a little nervous is there's a lot of problems when insurers reach pricing agreements for things they don't do. It doesn't play well. It sets you up for a lot of problems. It's not something you necessarily want to be deposed over or testify in. So Allstate did a lot of backtracking on that. The thing is that insurers will put out, they call it a guide. This is a guide. This is about what we think this should charge. Same thing that we talked about earlier when it came to KPIs and blending. Adjusters don't hear that because they don't possess the training to have the critical thinking skills to listen to what a shop or an ADAS provider is telling them, to read the information and then make an intelligent decision. It's not their fault. They weren't trained. When you don't know something, you just say no. So if I don't know how to engage in a discussion with you to determine why this is different or why it's more or what the next thing is, then I'm just going to go, we only pay $115. And I'm going to stand on that. That's defendable. I'm not going to get in trouble with the boss. I didn't pay too much. Everybody's got in trouble for the ones that were paying the $3,000 blind spot monitor, calibration. Nobody wants to get in that amount of trouble again. So insurers are struggling to try to determine how to regulate claims. That's their job. Their job is to have some sort of a repeatable process with a known parameter on costs so that you can set premiums, and there's all those things have to work. Has to. Like, it's not up for debate. That's how an insurance company works. The struggle is determining or trying to figure out how you get that with today's workforce. and the constant turnover that's in it. I don't have the time to invest all the training and the resources in you, because just about the time I probably get you, I don't even say to functioning. In all honesty, I was probably 3 to 5 years in claims before I knew what the hell I was doing. So not just going to barely get you to the point where you could like answer the phone. Remember when I first got hired, it was almost like 8, 9 months of training before you were allowed to touch a claim. And then you had job shadowing and whatever. By the time they would do that, these people, I mean, if the turnout ratio is in the 80 percentile, meaning people don't last past a year, then definitely that's a problem. So again, it's not an Allstate doing a bad thing. It's not a State Farm doing a bad thing in a lot of ways. It's not these companies doing bad things. It's really where we're at right now is this struggle of what takes intelligent thought, critical thinking, and what is more artificial intelligence. If I could set just a book of rates, I wouldn't even need adjusters, right? We just run an estimate through it and go, here's what we're going to pay. AI says this. There's still that need for that critical thinking, human intelligence, negotiation, debate, all of that. But the training to create the person that can do that isn't there. And that's really, I want to say it's on both sides. A lot of our estimators are hired, sit at a desk, and are told to double click this, single click that. And they're somewhat taught by insurers what you can and can't charge for. So they don't have a lot of independent thought. And then that means they don't have a lot of independence to be able to negotiate themselves either. And that's when I audit MSOs, and I do audit MSOs, typically I find the adjusters are they're just lost. They just don't know what to do. And that's causing as much problem on the shop side as it is on the other side. All right. So last Monday, we talked about Moody's downgrading Crash Champions. And I mentioned in my discussion that a part of me still remembers M2 and Fox Collision, and I can't let that go. That somewhat dread, fear that I have around those incidences. And there was a few more across the period of 3 years, but those two were sort of the biggies, the ones. And I started getting some comments and some DMs and whatever from people going, well, what was Fox and M2? And of course, my first response was, how can you not know? And then I looked at these people and was like, these kids they're like 22, 25. They were babies. Some of them weren't even in pre-K when this happened. And I realized, oh my God, I'm old. I used to go to events and I would look at the old people and I'd go, when the hell are you people getting out of this industry? We've got better ideas. We know what we're going to do with it. And now I'm like, I'm the old person, right? I'm the one. You ever been to a club and there's somebody at the club or the bar that's like way too old to be there? And you're like, what are you doing here, man? Like, this isn't your spot. Okay. I had sort of one of those moments last week when I realized we have so many people in this industry right now, some of which are claims managers. Like, I was like, damn, we have claims managers that don't remember these, that weren't around when this happened. And that's a little scary. So what I decided to do was I would give you guys, it's only fair. It was a legitimate question. Let's talk about what Fox Collision and M2 was. We'll start with M2. So M2 Automotive was an MSO out of California. Now, California starts a lot of MSOs. Caliber started in California. I was like, why is it bad things start in California? I mean, it's the land of fruit and nuts. I get that. But it was a MSO it's 2005. They had 27 locations and 700 employees. And one day they just didn't open. So people were technicians, the employees were trying to get to work and they couldn't. Everything was chained shut. There was a sign on the door that said, if you have personal property here that you need to get, call this number. It was a security company, call this number and get your stuff. What was interesting about M2, they were privately funded. So they had private equity investors, Fenway Partners out on the East Coast and GE Capital were their two main underwriters. And they were trying to sell the company. So he'd grown it to 27 locations. It had gone up for sale, which is what you see a lot of new, exciting little MSO startup, whether, they start with 5 stores and go to 10, or they get, they get to 20 or 50 or whatever. All of them envision that they're going to get to a point where they are then acquired by somebody else. So they're not trying to be necessarily grassroots growth like we saw the Calibers or the Gerbers of the world do very early, or there's Autobody America out of the mid, so like Tennessee, Mississippi, Alabama, Arkansas. They ended up selling to Service King, but everybody kind of wants to grow to be acquired, not necessarily grow to thrive and have the business. And that was what M2 was. They were trying to sell. Their sale went through, and then everything sort of fell apart. A lot of people, when you get to that point where you're looking to be acquired, you sort of start, I don't want to say spending money in a bad way, but you sort of like ball up, because you're thinking, okay, we're not gonna pivot, adjust, or do anything, because somebody else is fixing to come in here and buy this and take it, and we're just gonna like wait this out until they do. So the stall thing happens. But businesses don't get acquired quickly. Like, it's not like somebody comes in and goes, yeah, I'll give you like $29 million for it, and we'll close this deal tomorrow. There's a long process that happens, and well beyond my knowledge, education, or thought abilities. Like, not my thing. It fell through. And when it did, the whole world just started kind of crashing around M2. The investors froze all of the accounts. So to make sure, it was losing money, to make sure it didn't lose everything before they could come up with some form of liquidation, they ended up freezing the accounts, which is when everybody showed up for work the next day. It was almost like you went to work on Thursday, you tried to come in on a Friday, and the doors were chained, so to speak. And so that was 27 stores. And there was a lot of scrambling that had to go on between those 27 locations in California. There was a lot of claims in those shops. That was the heyday of volume, so to speak. A lot of cars in there. And now it's a struggle. I got to get my cars out. I don't know what stage of repair or disrepair those cars are in. I don't know if there's parts. They don't want to give me the parts because they want to return that and get a credit, so they don't have this massive, let's say you owe the Chevy dealership $150,000 in parts. If we can send some of those back and lower that debt, that's great. That was a mess. Insurers were trying to pull their cars, trying to get them into new shops, trying to find shops that can get to them. Rental was exhausted. Especially because of the DRP thing, you ended up having to go, we're gonna have to cover rental above and beyond policy or whatever. And so that was a nightmare. But that was 2005. In 2007, it happens again, this time in the Midwest. So a lot of people could be like, oh, that's just California, things happen. But in the Midwest, Fox Collision was an independent operator. It was not venture capital backed, investment firms or whatever. Body shop guy, grew it to 18 locations across 4 states. He kind of concentrated on that Oklahoma, Arkansas, kind of like triangle in there. And he closes down one day. No warning, no nothing. Didn't ask to be taken off assignments, to not have cars, sent to the shop or whatever. Just closes down. That was a lot of cars. What I found interesting, and I'm going to use interesting loosely, what pissed me off in this one was, dude was a DRP for a lot of insurance companies. And when this closes, that's what he blames. Same thing happened, honestly, with M2. In the M2 interviews, that basically DRPs, insurance companies, too much pressures, not enough profit, etc. Yeah. Wrote an open letter. So you can research this article and you can get everything, but wrote an open letter to the industry. And Todd basically says that this was all the insurance company's fault. And it's all because of DRPs. And DRPs are bad and shouldn't exist. And I'm going to work diligently with state government to try to do something. It's like, dude, you spent how many years chasing them, swearing that this was the way, this was how to make money. You were a top operator. You were a model for the insurance industry, a model for the collision repair industry to follow, and all of these things. And then this is what happened. And again, just like M2, there's a scramble. Got to get the cars out of there. You have creditors that don't want to release parts, that don't want to release anything. And you've got to figure out where are your cars at? What stage are they in? How much money have you spent to date? What have you spent that money on? And then what do we do now? Again, we were in the same boat. We're going to end up having to pay extra rental. We got to get the cars moved. It was difficult. Wasn't as bad as like an M2. There was less locations, less volume, typically in the Arkansas, Oklahoma area than in Southern California, so to speak. But same thing happened again. And that's why I say I get a little nervous. Like I still have a little heartburn whenever I start thinking about something of more than 20 locations showing up one day and being bankrupt and the doors being locked and the IRS is there wanting their money and creditors are there wanting their money, etc. And you're trying to get the cars out and you're trying to take care of the customers. It still makes me nervous. It's still a little, not nervous. It makes me queasy. I mean, just that I can't even tell you how bad those weeks are after something like that happens for an insurer. It's terrible for the employees as well. You wake up one day and suddenly you're unemployed. Most of those employees, between those two, were able to find jobs. Not so sure that everybody's going to have that good of a luck this time. But I thought, since it was coffee talk and there wasn't a whole lot going on, there wasn't a whole lot that went on this last week, we'd have more of a coffee talk conversation. We just sort of speculate and talk this through as if I'm sitting in your office or your shop this morning and we're sipping our coffee and talking about the news and sort of like talking about what was on TV last night or the ball game, because it's football season. So I'm about to be talking football 24/7. But let's speculate a little. Now, Repair Driven News made the links available on their coverage of the recent Moody's Crash Champions downgrade. So they went from a B3 to a CAA1. Deja vu, right? So Repair Driven News linked everybody up so that you can see that this is exactly what happened to Service King. This just happened. The first time we got this was right around the start of COVID, where they had gotten downgraded and started thinking, if you can see this, if you are watching on the non-audio versions, on the video version, that very last paragraph down there where it talks about the debt ratio and the numbers, you probably want to go back and look at what came out 1st of August from Moody's regarding Crash Champions. I think you're going to find there's a lot of really eerie deja vu things going on between this. So this comes out in 2020. Now, the concerning part for a lot of us when this happened is, sure, this was the start of COVID and we didn't know what was going to happen. Right in March, there's a meeting in here where the Texas governor had, who's going to be an essential worker, who gets to stay open. A lot of us were really, we were scared, I think, at the front of COVID, what was going to happen to our businesses or whatever. Then as COVID went on, it wasn't necessarily a bad time to be a body shop, was it? A lot of us ended up getting booked out several months. It seemed to be a lot of work. There seemed to be, a lot of things going on. Wasn't a terrible time for a lot of people. We even were talking, we did the World's Fair and did some things during COVID. I remember several episodes I was going, hey, don't get too caught up in this, right? Like a lot of people were like, oh, it's the shift of the industry that we've been waiting for, where repairers are going to become more important than insurance companies because of the demand and the, whatever. And we were like, don't get too carried away with this right now. This isn't going to last forever. There's going to be another side to this. This is not necessarily like the projections and the numbers were not supporting that this was a permanent change in the market. But it should have been a good time for growth and profitability, I guess, for the independents. I mean, the MSOs might not have been able to see it that way, but it felt like we all had a lot of work. So I think we were all a little shocked that 2022 comes and Service King's position had not improved, that it was bankruptcy. They were trying to, there was court on some of their debt and they were looking at, restructure or whatever. debt was converted to ownership from some of the debtors. What's going to happen with that? Then there was a little bit of a, hey, these people are going to come in and be the new owners, so to speak, and they're going to pump another, was it 240? You guys can fact check me, or I think it was 240 million or whatever we're going to pump into the business to sort of like revitalize it. And then a couple of weeks later, it was like, nope, never mind. Crash is going to come in and take it. So a lot of us were really kind of looking back. We're like, how did that? I mean, COVID was a great opportunity to close low performing locations, focus on the ones that were making money. But so we were all a little confused. I mean, I won't say that. I can't speak for everybody. I was a little confused that things necessarily hadn't gotten better. But I think sometimes when something's so big, it's really hard to pivot. And you have more regulation on you, the more employees that you have, but it gets so big to pivot that 2022 came and it was done. It was over in sweeps crash. And now here we are, 2025, and we've had an announcement that feels like it's May of 2020 all over again, so to speak, except without the claim load or the car count that we saw with COVID. Now, what else is sort of going on at the same time? Well, we have what feels like this thinning of the space. For a long time, a lot of people associated with the industry, because I don't want to say they're in the people that are the lifers. There's a lot of people that, are multiple generations. They've been in this industry a very, very long time. That's not just something that a few of us get to say that we own that space. And so there's all these people that have been in the industry a long time, and they sort of different perspectives, which is interesting. But one of the things lately, I hate for 99.9% of the industry, you don't get to be in these, what I like to call the free drink ticket conversations. And what I learned in my time was that, not a lot of business actually got done in meetings, whether that was CIC or whatever it was, that a lot of that was pony show. Everybody was doing whatever they had to do for their job, their role, whether they were an insurer, whether they were a paint company, whether they were an association or whatever. Everybody would get up in public and do their dog and pony show. And then the real conversations took place at the reception that night when everybody had the free tickets. So sitting around the tables was where you heard the real conversations, where real business got done. A lot of it got done in the hallways as well, but sitting around that. And it always sort of bugged me that 99.9% of this industry is affected. Not just you miss out on the conversation, but you're affected deeply, financially, personally, whatever. You're affected by those conversations, and you don't even ever know they happened, and you don't ever get to get on them. So I like to talk about what we used to talk about so that you guys can figure out. That's why I stopped going. People go, but you don't go to the association stuff anymore. No, it's pointless. It just really is. Like, they don't speak for you. I know a lot of people want to say they're your voice, that they're working for your best interests. You do you. Right? You work locally with your people and you handle your stuff, because on a national scale, the dog and pony show isn't necessarily thinking about you when they're there. And some of the people have the best of intentions. There's been so many people that have started these things and they come to the table. It's sort of like a politician. You come to the table green and eager and you want to change the world. And by like the fifth meeting, you're meeting with big pharma and big paint companies and whatever, and you're told that you can't change the world in a day, and you got to slow down and pace yourself and pick and choose your battles, and you get told all these things that make you sort of vanilla very fast, and before long it's your 15th year on something and nothing has changed. It's only getting worse. So yeah, that's my rant on that. But those conversations right now, no matter what part of this 30, 40, 50 years that you have, there's one thing that everybody is sort of agreeing on. There's a lot of things people don't agree with me on. The one thing that we're all kind of agreeing on is that the space is starting to thin out a little bit. Like, so this whole collision space, for so long, it's been promoted as this big blue ocean of opportunity for venture capitalists, for everybody. It's free money. Get in here. Insurance companies pay claims, not consumers. And we can all just kind of like have a hoorah and make a ton of money. But now things are starting to thin. It's almost like the investors, like the Fenways back in 2005, have sort of went, we're not getting the return we thought we were going to get. Like I got this perspective that was given to me. I was told that this was a recession proof business or whatever, but we're just not seeing the returns. We're seeing a lot of money being spent, but we're not seeing the returns. And so you start seeing things that are popping up for sale that are not body shops, and they're not the MSOs, but the things that are supportive businesses. So there's this thing that is OEC up for sale. Well, they've got an owner, and then they also there's a couple of OEs involved in that. So is it up for sale, and why? Why would they want to turn that over? Good group, good products like what they got going on. BASF, the original report when BASF went up for sale was the BASF people said that there are changes in the market that aren't necessarily favorable, and we just feel like it's time to go on. What are those changes they saw in the market that made them want to leave the refinish business? Now they got a big chunk. It's not just collision repair refinish. There's automotive. There's a whole lot of coatings that they have, and then you got Caliber filing for their IPO, which I've talked about, I think 2 episodes back. I really feel is an exit plan. I feel like it's the Caliber investors are like, okay, there's no one that's going to buy us. I honestly don't believe they want they don't want to acquire anybody else. So an IPO is an exit plan. I have a feeling there's a lot of them sitting around going, can we just get this IPO over and out and done before whatever is going to happen over here with any other MSO happens? Because if we have another Service King situation, what will that do to their IPO? It'd be interesting to have the financial experts kind of explain how that would affect them, how it would affect finding somebody that wants to underwrite that IPO and all of that, if that did happen. But you have what feels like there's this thinning starting to happen. And that's, in my mind, I think that's a good thing. Like, I'm not, it's going to hurt. It already hurts. I mean, I think people were calling me last week, and I was like, don't take this personally. You're already hurting, right? You're already lower repairs, a crunch on profitability, increased expenses from paint and material. I mean, everybody's hurting. This isn't like, one company's all alone in their financial struggles right now. Everybody's sort of having some problems. So it's time for some sort of change. And I really think that as this sort of thins out, the real will survive. The people that flooded the market or, whatever. I had a guy call me a couple of weeks ago and asked for a meeting. And I was bored and had time, so I took the call. Probably shouldn't have. But he had read some magazine report somewhere of what the most profitable businesses were to get into if you wanted to be an entrepreneur, and automotive collision repair was one of the ones on there. And he told me, and I laughed out loud, and I was a reaction, and I didn't control it. And yes, I should have been more professional, but I started laughing. He's like, "What's your thing?" And I was like, "Look, I don't know what report you read or who wrote it or what it's based on, but and I love the collision repair space, but now is not the time for somebody that knows nothing about collision repair to think you're going to enter this space. Maybe give it a year or two. Let's see what it's like next year, but right now is no." And he was like, "Well, I'm looking for a place to buy, and I want to buy a place, and then I want to start my own business." No, just I mean, like, my best advice to you. And he's like, "What? I need a consultant." I'm like, I would love to take your money. But no, like, this is not the time. But I think for those people that have been in this space a while, the true independent, and not just independent, but because dealerships will survive this as well, but the people that really have a grasp and running their businesses efficiently, effectively, profitably, I think this thinning is sort of a good thing. It's almost like returning the space to where it should have been. It ballooned, it mushroomed way bigger than it should. And I believe a lot of our MSOs are even feeling that right now. But as this thinning happens, I get asked a lot, what's going to happen if something I always say, I don't necessarily want a huge class action bad faith against the insurers. I don't want claims to collapse, and I don't want the ecosystem of collision repair to collapse either. But what did the insurers learn between M2 and Fox? So I want to give you some historical perspective here. When I first started working in DRP, and I had my like your first little group of adjusters, and you're managing your first little section of DRPs. One of the things that we used to do is that initial estimate. When the shop wrote that initial estimate and sent it up, we paid. We sent out a co-payable check to the shop and to the customer. That's that direction, authorization to pay, direction to repair forms, and all that. We sent that money out fairly quickly. You were generally looking for a second payment upon completion or just a deductible payment, but we were pretty proactive in trying to close claims, pay them up front, and move on. One of the things, if you'll notice, and you'll look at the date on this article, because I went back and started pulling out my old files and going through them and going, let me just replay some of these dates. I keep everything, by the way. February of 2006, State Farm announced massive changes to the direct repair program. So from Service First to Select Service, it was going to go from we like you, and shops have picked you, the local managers have picked you based on your performance and history and your willingness to work with the customer and your reputation and whatever, and just we're going straight numbers. It's just going to be a straight performance driven program at that point. And shops lost their mind. The feedback, the favored nation clause, like everybody was going a little nuts. So what did we learn? Between M2 and Fox, if you look on the dates of the calendar of what happened, we learned DRP had to be run completely differently. And lots of significant moves were made in changing the contract and how the program ran based on those two incidences. There was no, we're going to terminate DRP. A lot of us within the insurance industry, well, on sort of the old school estimator side, we were like, see, we told you that damn DRP thing was never going to work. You got to remember, not a single estimator wanted DRP. That was a claims directive from customer service, not from the estimators. So we're taking victory laps with these two collapses. We're like, told you so, told you it wasn't going to work, told you that we needed to control claims. Like we wanted to take a victory lap. Well, nothing happened. We didn't get our way. DRP didn't go away. It sort of doubled down. It almost got worse. This is where you start to see the experienced estimators leave the table. Like the original DRP was people that had been field estimators that were brought into like a Claim Central environment. They ran it. Now you see them cycle out, and we don't have experienced estimators at the DRP table anymore because we're not doing a repair. We're just driving KPIs. This becomes a completely like a performance generated program. Things that we learned. We changed it where shop pays for everything. Basically, there's now a clause in that agreement or in the agreement you look at where the shop gets charged for rental, the shop gets charged for, just about anything became your problem, not the insurance company's problem. One of the other shifts you saw about this time, and I visited with like shops that are in our group last week because I was talking about this with a couple of insurance friends that had called to say, hey, let's talk about crash and kind of get some thoughts on it. Now in DRP, you get paid when the car delivers. I'm not going to get caught anymore with cars in a repair process. And I've got to go, all right, well, I paid for these initial parts. The shop uploaded an estimate after teardown. I sent a check, and we paid for parts, and now I need to go get my parts and I need to get my car or whatever. I'm not paying for nothing up front. You get money, sometimes longer. Some of you said that you got money 3 to 5 days after the car delivers. Some of you said it's longer if it's more money. So the larger the estimate, like it may take 10 days or whatever, but you're not getting anything until the car goes. And that's mostly a self-defense tactic, things that we learned that we don't ever want to have happen again, right? And then basically the favored nation was, if you're going to cut a deal, that's what happened after that. And some economy things as we led up to 2007, 2008, with the economy and the housing crisis and all that stuff that happened, was shops were desperate to get on other DRPs. But that's what they thought was the only way they could make money. They were offering all of these freebies, all of these discounts, all of this stuff to other insurers that technically had lower claim volume. So that's why the shops did it. They're like, well, we're going to offer these great discounts to Allstate, but we only see about 4 Allstate cars a month. So even though, we're going to do that to get them in here, but it's not going to be that big of a deal affecting us. So we just basically said, oh, no, 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 no. Whatever you're willing to do cheapest is what we'll pay you. So you're only as good as your lowest rate, your lowest repair, your lowest, your discount, whatever that is, that's all you get. You don't get to charge one person more than the other or whatever. And that's where that came from, is because shops were sort of like, I need more DRPs. It was almost like a crack volume game. Like, I got to get more claims in here. I got to get more work in here. Well, whatever I got to do, which sounds like what you read in that email or that story that had been put out, where it's basically like, hey, if you can deepen your relationships with insurers and increase volume, then maybe you can save the business. It doesn't work that way. It sounds good. So we put a clause in that says whatever deal you do, you will live by. And at that time, it was no longer. At this time when this came out, State Farm was the largest auto insurer in the nation. Now they're not. They're not the biggest. There's Progressive, and I think Geico's even passed them now. But it was just a matter of fact of, I'll be damned if you're going to cut Progressive or Allstate a deal that you don't want to give us. And so those changes happen. And well, what does it mean? So as I talked to some insurers last week, and I'm going, because remember, I'm Fox 2 and I'm Fox and M2 sort of paranoid. Like I'm sort of itchy, right? I'm like, what are we going to do? This is like, what, 400 or 500 stores, and how many cars is that, and across how many states and how many regions? And I'm just starting to like think about what the catastrophic plan would be, because make no mistake, there is a catastrophic plan for everything. I got to participate in making the plan for how we would service Hawaii if it was hit by a tsunami. We were going to purchase a cruise ship from Carnival Cruise Lines. We were going to go to LA, put everybody on the boat, right? Sail 10 days over to Hawaii. And then eventually, because we didn't know what the roads would look like, there was no need to bring all the company cars over. Initially, we would play that out as it went. And I'm thinking, it's pretty cool. We're making a plan for a cruise ship. We had to have conversations and negotiations with Carnival. I mean, there was a lot of work that had to go into it. Make no mistake, there is a contingency plan for just about everything. Insurers leave nothing to doubt, and they do not like to be surprised. So they plan everything. So is there a catastrophe contingency plan for if an MSO goes under? Nope, because they don't need it. Like they're going to have to relocate those cars to a different shop, but they're not necessarily out the same claims money we were sort of out the first time around, because there's nothing put out on the first claim. Those cars are in the shop, whether they're in storage or whether they're in WIP, without a claim initial payment under the file. So I can go get those cars and I can move them somewhere else under a different DRP agreement where I don't have to pay again until the car's ready. Now, do we have to make a decision on what to do with rental? Sure, but I think we got that answer in COVID. When cars were taking so long to get repaired in COVID because of, hey, there's too many claims, they're on a wait list, parts aren't available, all of those things, the insurance companies didn't go, yeah, it's out of your control, we'll extend and pay more rental than your 30-day policy. They left people 6-7 months in cars that probably should have been totaled while they waited on parts, like the Honda story that came out, right? So they don't plan on paying rental. It's just very much like it doesn't matter. There's not a dread. There's not a worry. We were worried when M2 and Fox happened. There was palpitations and hyperventilation and worry, but they're just not worried, and it's part of what they learned and made some adjustments. So in other words, they learned from that, made some adjustments in contracts and what happened. And on the other side of the fence, now if that happens again, whether it's one of them that goes under, they're perfectly ready and able to disseminate that through the network with no problems whatsoever. And then they still have a waiting list. So there's still a bunch of shops that want to be on the DRP program. So if they had to pump up volume or add shops in a market to process cars through, not a problem whatsoever for them. They're not worried at all. What does that mean for the remaining MSOs? So we're just speculating and kind of talking. You're probably going to want to like hold your phone up and maybe record this. I may delete this whole presentation or this whole morning's coffee talk at some point, because I'm about to say positive things about Caliber and Gerber. And I don't do that very often. So one of the things that I have watched those two companies do, Gerber more than Caliber, there's been very strategic, measured growth. There hasn't been, Caliber kind of in the beginning, if I want to say like around 15 to 17, sort of went on this wild purchasing spree across the country. Gerber was a little bit more measured. They seem to think through things a little bit more. Lately, like the last several years, Caliber kind of got that way. And here's what they learned. Those original purchases, those original years, the 15, 17s, 18s, up until the 2020s, you would acquire a place. They owned the real estate. You didn't want the real estate, right? You wanted to be, and I remember State Farm went through this. When I first started with the farm, I ended up being really good friends with this kid I had met at claim school, and we were studying together because back then, if you failed one test, you were fired. So we were studying together, and I think we're in the second week, and he goes, "Hey, let's on lunch break, I'm going to go up and see my dad. You want to go with me?" And I'm like, "What do you mean go up and see your dad?" Okay, this guy's dad ended up being the vice president of real estate for State Farm. Who knew? But what he did was, it was his job to determine, and he would read population reports and the census and whatever, and he would look at cities and he would go, where's population going to go to? What's going to grow? Where's this going to move? And he would go buy real estate and he'd build claims offices. And I can remember going and working in some claims offices, and I was like, why did we put a claims office here? Like, it feels like we put it in like the worst part of town. And if it wasn't 5 years later, it was the booming best part of town. I think about the two offices in Arkansas that got built, the one in North Little Rock, the one out in Chenal and Little Rock, and then the one in sort of South Little Rock that was out on Colonel Glenn. And I remember when they built these claims offices going, these are in the middle of nowhere. The North Little Rock office at the time was almost in a crime zone. We had a big fenced in area, and we were constantly, our cars were getting broken into or whatever. And I thought, why are we here? And it wasn't like 5 years later, they built a new hospital right out the front door of the claims office. and Chenal became the big fancy place in Little Rock where all the big houses, like, it was like this guy was a wizard with being able to predict. I look at the MSOs, and a lot of them stopped. They're still buying some shops in key locations, but they got very strategic. And they started thinking about growth, where population was, looking at insurance, policies in force, where those zip codes were. And they got really good at greenfielding, basically going and building their own stores in specific areas that needed service. Like, there's people that live here. The numbers show that we can put volume in these stores, and they would build. And because they were building new buildings, these triple net leases, I mean, some of these shops these guys bought in 2015 were just hellholes and needed complete renovations, but you got a triple net and you're like, do I want to put 100,000 into a building and then put new equipment into that building and I don't own it? And the answer is pretty much no. So you've seen them, like this year, we covered it. We talked about a lot of shops getting a lot of previous owners getting letters that they were not going to be renewing their leases, and you will be getting this businesses back. But it feels like instead of going and buying existing, there was some real strategic thought like around between those two, and probably maybe some others, but just watching those two move when you're the biggest in the industry, the moves you make, obviously they get a lot more attention and you watch them. But if we've spent the last time over the year, there's just been very methodical and very strategic. Honestly, I don't know who would come in and buy a very large MSO right now, particularly if you're a national MSO. So a lot of people are like, oh, Caliber is going to buy Crash. I don't think so. Like, I just don't see it. There's too much overlap with what existing sort. Like, you watch them now and they're being very strategic where they're building. There's overlap. Probably 60% or so of those existing locations, they don't need them. And specifically, since a lot of them were the old Service Kings, why would I buy something and buy a competitor in my town that's just right across the street from me to what, close it? Like, that doesn't make any sense. Do you see people wait and let things happen naturally and then cherry pick locations? I would imagine a lot of those are going to go back to the original owners. So if things do fall through, they'll go back to the original owners And then those original owners probably don't want to be body shop owners again. So they're going to go try to find somebody to like, retake it over. We shared Laura Gay, who's a consolidator and, consolidation consultant in the industry. She had sold two of her stores to Caliber, and she got one of them back this year. She made a post, she got it back, and now she's trying to sell it again. And I haven't seen anything else, so I'm going to assume she found another consolidator group to go into that location. But will all those people get those stores back? And then can your people in the industry that may be interested in growth be very selective about where they actually do grow, instead of having to take a chunk of business that probably overlaps areas where they already are? And then what would you do with that? There's not, I mean, we look at the claim volume right now, there's not enough claim volume to keep all of those stores busy. So why buy something you would just have to close down? And I think that's that thinning right now that everybody's trying to sort out and go, what does this look like? And what is that? And it's why I always tell people, I really think right now Caliber is just hoping their IPO can get done before there's any massive problems. But, there was this announcement just came out just last week. They had a ribbon cutting on one of their new stores. I was out in Texas last year, and then I was in Texas, Idaho, I was in some really Wyoming. I was in Wyoming, and I was driving by all of, everywhere I went when I was in these remote locations that had population and service issues. In other words, I had more claims than I had body shops in a market, it seemed. I found a Caliber being built, and I thought, man, they're being very strategic. I was in one place in Texas probably 3 or 4 years ago, working with a sport coat company. They paint football helmets, of all things. And right behind them, they were building this huge new Caliber, and it was a cow field. I mean, literally, it was a cow field. And I'm like, what are they doing? Right? Like, it doesn't matter. 2 years later, my kid ends up, so he was an ESPN 300 top recruit, whatever. And we're at a football thing in Texas for the NFL. And they're going to have it at this Prosper High School in Texas. And I'm like, that sounds familiar. Okay, that was where we were, basically. Now there's a new high school. And when I say new high school, this thing's larger than where I went to college. The size of this high school is. But people, like the population influx in Texas, just everything growing out and north from the DFW market. And so what was a cow field is now a population that supports 2 high schools. And both of those are the size of where I went to college. And it was like somebody was looking at a map, kind of like the State Farm guy that I went to school with, his dad, and was predicting where people were going to go, and was getting in on that land early and projecting and building collision repair centers. So like I said, I don't say positive things about Caliber and Gerber a lot, but I've been impressed with the way that it seems like they're approaching it very, very market specific, trying to fit very specific claim models, very specific claim counts in markets, instead of just like trying to go out and buy some things. So I think that thinning, if we look at those two, they've done a good job. I don't know if there's another MSO that's going to want to get in that game. I didn't really think anybody would have bought Service King. That surprised me. I thought nobody's going to do that. It's a mess. Like, who would buy it? And then I was surprised. So I could be surprised again. Like, it could completely come out of nowhere. But when I watch what I would say are two, I don't want to say our biggest, but our two sort of oldest, Caliber and Gerber, have been around a long time. When I watch what they're doing, I just don't see that I see like they probably started planning for this, years ago, and started thinking about how this thinning of the market was going to look like. So very interesting. Just around the cooler coffee talk this morning. All right, let's talk about, so there's so the insurancethoughtleadership.com is like a little publication. People write white papers and submit them. These two gentlemen, Alan Demers and Stephen Applebaum, have been around the insurance industry for a very, very long time. I've known of their work, more interacted with Stephen more than I have Alan. I've known of their work for a long time. By no means are they fans of Collision Hub, and probably not super happy that I'm talking about their stuff, but I enjoy reading their stuff. It's a different perspective. They focus completely from the insurance side, technology, insurer tech. That's kind of their thing. I'm old school claims, and I'm like, it's people business. It's not a technology business. I get that I'm standing here basically being Blockbuster. Totally understand that. But anyway, they put out this paper in August 14th. You can go to the insurancethoughtleadership.com and you can find it. You can also find these two gentlemen on LinkedIn and get to the story that way. What I thought was interesting is how claims is changing and how it's affecting claims, and then how it's also affecting body shops. So it's interesting to see the insurance side. But a little snippet out of this article that was very interesting to me is I've been talking about the total loss percentages and what was going to happen for 6 years now. When I first gave a presentation in Chicago, of all places, on total loss, and showed the insurance perspective of 47% of claims becoming total losses. And again, that was another one of those things. She doesn't know what she's talking about. It's clickbait. She's trying to get you to buy her total loss class, all of these kind of things. Great, whatever. So when the people on the insurance side of the fence start talking about the same thing, it's pretty valuable. Little snippet out of here. Total loss claims, which generate significant opportunities for lengthier replacement of rentals, right now have soared to 29% of claims. So remember, we said by 2026, it was going to be 47% of claims. It's 2020. By 2024, 29% of claims were total losses, which is a stark increase from 17% in 2018. So we're rising it, right? We're already at 30% and it's 2024. And I love this little addendum. Now, with almost 30% of collision claims ending in total losses, carriers need to place an even greater focus on speed. So how fast you handle a claim. You want to control length of rental. You don't let a car sit for forever before you make a total loss decision. So they need to focus on speed and customer satisfaction in the process. Total losses, that's a moment of truth, right? Typically in a repairable, we talk about brand turnout in the OEs. Like when a car is totaled, brand turnout is high. People buy another car for whatever reasons. That car shouldn't have totaled. It didn't do whatever. I don't like it. I'm going to go buy a different brand. So brand turnout and total losses is high for the OEs. It's also high for insurers. So in other words, now your car's a total. I'm going to go shop for premium. So we used to put a really big focus on customer service and total loss claims that, at least in a repairable, I may get to touch you 4 or 5, times and make up for it, so to speak, if we mess up. But you're going to keep that same policy on that car. I got to really piss you off to make you want to go shop for insurance. But because your car's a total and you're going to go buy something new, that's really when the consumer would shop. So brand turnout is not something that just affects OEs. It affects insurers as well. And so 30% already, we're 2024, 30% of reported claims are at total losses. We only got to get about 16% more before we're right at where that projection of 2026 is. It is, these guys do a great job. So like I said, I think you should know more about the other side of the fence. Like, our 700-year-old book, The Art of War. I need to know the enemy. Know the enemy, know yourself. So if you see them as an enemy, but you need to understand what's going on in that world more than just what your feelings are. Like some Repair Driven News does something and you get mad at what you think the insurance companies, well, they're making too much profit. They reported record $1 billion premium growth or whatever. Sure. But understand what else is there. And so these are two people I think you should follow and read. I read them and enjoy them. I'm probably going to get some hate mail and they're going to ask me not to talk about their stuff anymore. So, but here we are. That's where we are with total losses. Now, what does that mean? If you want to go back, remember 2006 when we changed the DRP contract. One of the first things was you're going to do total losses for free. So if you're on the DRP program, you're going to have more cars coming to you that become total losses. That's less revenue. Still work. You're still going to have to work those claims. You're still going to store those cars. You're still going to have to do a lot of things, but you're not going to get to make any money on them. So are you prepared to make less money because you got less cars? And if you do that, what does that do to your cash flow? If you look at these big MSOs, their cash flow, I don't want to say dependent, but vulnerable, right? The smallest difference in cash flow has dramatic effects on them for overall But if you're going to have that decrease, are you ready? For some of you, probably not. That would probably be catastrophic if you started looking at an increase of total losses and less repairables in your market. What would that do? Do you need to make more money on total losses? So maybe it's time to get off a DRP program and look at total losses as a profit center. I do have a class on that, but I'd love to sell it to you. In fact, it's part of the Coffee Talk bundle. You could email Melanie and go, Melanie, I want the Coffee Talk bundle, and it's in there. But even if you don't do that, at least go get some total loss training, start talking about it with other shops in your market, because it absolutely has to be a profit center. And insurers don't want it to be a profit center for you. And they don't think it is, because historically it's not been. Most shops pretty much handled totals for nothing. And when you do something for nothing for too long, that started becomes what it's worth. And so now that you want to charge for them, there's a lot of, there's a lot of legalities, there's a lot of bills. You got what's going on in California, got what happened in Oklahoma, but definitely time to start thinking about what you're going to do with rental cars. Okay. I'm just going to mention this because it made me laugh. So I'm gonna okay, Edward and Sean. Um, um, Hopefully it's annoyed you enough if you came back for round two. I get chuckled at the comments. I love comments. I was telling a guy on Facebook yesterday, basically, it's my job to get on here and argue with you. That's what I do, right? I get really tickled at the people that the complaints of, I don't like the sound. You get, and I've upgraded the sound. So for those that were complaining, look, I keep upgrading and trying new microphones, and I've had lapel mics, and I get that. You want to hear it, whether it's in your headphones, you've got it on a speaker in the shop, you want to hear it. So I'm working on trying to do that. But I want to be very clear. It's like 4 o'clock in the morning, Edward and Sean. I don't know if either one of you could carry on a 1 hour complete conversation with no breaks on multiple topics and not have some sort of pause word for thinking. Yeah, no, I don't think you could. I think you would need to be edited. I really think that there would have to be major editing if the two of you were going to wake up at 4 in the morning, walk upstairs, turn on your camera, and talk for an hour. Now, should I maybe turn Coffee Talk into something more like New Heights, like the Kelsey brothers, like the football thing? Maybe if Taylor Swift decided to take an interest in collision repair over sourdough bread, I might invest more. They have a podcast producer, and they have a camera staff, and they have an audio team, and then they have an editor. So after they record, it's all edited together, and they have segments and whatever. And I just don't have that kind of time, John or Ed. I just don't have that kind of time, right? So I wake up on Mondays, and I walk up and I turn on my camera and I talk nonstop, and I just record it. The mistakes, the whatever. So I'm sorry you don't like my ums. I'm sorry you think I'm borderline delusional. If I haven't had enough coffee, probably. But keep the comments coming, because they do entertain me greatly. All right, let's finish this up for the day. What is on the shelf? See, there it is. Sean and Edward, one more just for you dudes. I had a call first part of last week with a gentleman that was in our our RTA class. So Mark Olson and I taught a 3-day RTA class, and this guy was in it, and he called me afterwards, and we had a discussion. It's always interesting that there's all these people from different insurance companies that are now on different sides of the fence. And then people are like, do you know so-and-so? And I like, literally, there were 80,000 employees at State Farm. There were another probably 70,000 at Nationwide. No, we don't all know each other. Like, I wish we did. I got to go around the country and do a lot of things. I'm terrible with people. I'm great with cars. I remember some people and I remember some faces, but anyway, he was in Louisiana, and really interesting because I had the Mid-South, right? Monroe, Louisiana was our head office for the Mid-South region, and I was down there a lot. And how we didn't cross paths, I don't know because that I don't know. But we started talking about people we knew, and we knew the same thing, so that was fun or whatever. But one of the things that came out of it is, so I told you I keep everything. I asked him if he was Thumbody, and he knew exactly what I was talking about. We had a regional publication called the Lanyap, and so that was for the Mid South. And the regional VP used to go around and tell everybody that they were Thumbody, and it was cute. So it was a little annoying, but it was cute. And he was a good dude. And so we talked about that. And it turns out he's still around. I would have thought I might have died by now, but no, he's still around. He's in Monroe, Louisiana, and he occasionally sees them. But anyway, I still have my Lanyops, and then this was the auto claims magazine that would come out from corporate, and I have all of I don't know why. This one I had it marked because there was a really cool article in here about how to make a claim committee report. And it's detailed in General Claims Memo 300, which is up there as well. And claim committee reports were fun for me. And that was when you had a claim that you were asking someone outside of your office, a group of people, to review it for a coverage decision, an interpretation, or whatever. And so claims committees were like going to the Supreme Court. Let's think of it that way. And I really loved them, and I wanted to get very, very good at them. So I saved this very early. This is from 1995. So this was the Auto Claims Fire magazine from, I'm old. So this is the Auto Claims magazine from spring of 1995. So there's a whole bunch of them here, and there's always little articles. Please don't forget to vote, right? I love the back end. Here's your general claims course from 1995 that you could take. Anyway, I have them all. So that's what's on the shelf. Back behind me, there's always a lot of fun things. People always talk about the Hey Kristens that Melanie does, and I'm generally somewhere sometimes digging through a bookshelf, and people are like, that's totally fake. And I'm like, I spend a lot of time back there. Something will happen and I'll go, I have that somewhere. And I go and dig through my shelf and find it. So that's what's on the shelf. All right. I hope everybody has an amazing week. We are in the middle of a super heat wave down here. And then I'm hoping it breaks this week because football season is upon us. And I do not want to sit in the 100-degree heat and watch football, but I will because I love football. I hope you have an amazing week. If you need anything, you can reach out to us, but please don't reach out to me because I am like a squirrel. I can't remember anything. Send Melanie or Holly an email. They will always have the best answers. But if they do need to get a hold of me, they make that appointment and put it on my calendar. It's kind of like my mom's making my calendar, so I know what to do. But reach out to them, and anything we can help you with, well, we would be glad to do that. And we'll see you next Monday on Coffee Talk. But before we go, for my two biggest fans on YouTube, okay, bye everybody. See you.